Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Brad Dillman, housing economist with Cortland. Brad, it's great to meet with you. Welcome to Trade Talks.
Great to be with you.
On a macro level, how can you distill what we're seeing in the housing market and the broader economy?
Well, in housing, it's going to be slower price appreciation in annual terms, right? So I think we've seen the peak in annual home price appreciation. It's likely to slow from here. And that's very clearly a direct function of the movement in mortgage rates. As far as the macroeconomy, obviously, there's a lot of concern about a potential recession. From what we see and based on job openings data that just came out today, I don't think we're in for anything that I would characterize as a recession if the Great Recession were to be any kind of standard against which we would measure it.
What factors are driving interest in renting versus buying?
Well, so there's been this tremendous home price appreciation in the last few years that has seen double-digit year-over-year home price appreciation. And so when we think about how quickly that's gone up, you really need incomes to stay with it. You really need people to have more and more savings in order to afford these homes. If you look at the savings rate, the personal savings rate is flirting with decade lows.
How many homes is America short, and what is a lack of housing inventory doing to the housing market and apartment rental rates?
Yeah, so our estimate is that the U.S. is underbuilt by about 1 million housing units. This is a situation that's actually getting a little bit better. We do have 1.68 million housing units under construction. So if you compare those two, there are more homes being built right now than we actually need. But at the same time, and one fly in the ointment here is just what's going on with population growth. We know there's been some kind of return to historically normal levels of legal immigration, but there's also what's been going on in terms of illegal immigration. So we just have to know how much the U.S. population is really increasing in order to be able to gauge just whether or not we're overbuilding the housing market right now or not.
Do you think we'll continue to see increased rent growth in 2022?
Oh, almost certainly, yes. So annual rent growth right now across the submarkets we track is about 16%. It's expected to slow down over the remainder of the year and into next year into something that's more historically normal. But based on our forecast, it looks like it's going to be a little bit higher than what has been seen over the last 20 years. That's another way of saying that the lingering effects of the underbuilt environment, the lingering effects of inflation in general, and what we do think will be a proliferation of these inflationary effects into wage growth will be felt in rents as well.
Right. And you had mentioned before that you're seeing the lowest levels in interest in savings rates. And you'd have to imagine that elements like inflation, like supply chain issues really have impacted the current state of housing inventory. I mean, how can you potentially save when you're spending 8, 10, 15, 20% more on food? And of course, we know what's happened with gas. Do you think these issues are going to start to level off? Or is this something that you think the market's going to have to contend with for some time to come?
When I read analyst reports, I think there's a lot of consensus that peak inflation has come in. The real question is just how much inflation is going to linger. Do you think there's going to be what's called disinflation in economist speak, which is a slowdown in the inflation rate when it comes down to goods in particular, but services may remain somewhat elevated? What we're really going to be waiting to see is to the degree that the labor market remains strong, is the eventual return of real wage growth. If you look at wage growth for the last year and a half or so at this point, it really hasn't kept up with inflation according to the standard inflation gauges.
Right. And Brad, how much has the switch to remote and hybrid working affected the U.S. housing market and demand for inventory in new locations? What regions did see the most impact there?
So we saw tremendous home price appreciation and rent growth in Florida in particular, and in other Sunbelt markets, parts of the near West. Boise stands out as an example. But Florida, just as an example, you've seen there 30% year-over-year rent growth in some markets. And that's really driven by people moving into the state who are taking incomes, from other parts of the country, be it because of COVID or because of a more permanent migration. And that's really increased the real cost of living in those areas. Now, new lease signees, these people are having, incomes that are keeping up with rent growth, even surpassing it. But when we look at broader metrics of incomes, it doesn't look like, the majority of people out there really keeping up with the kind of inflation that's occurred over the last 12 months.
Do you think that we'll see a push back towards reurbanization?
I think we will, to a degree, and we can already see this in urban core rent growth, which has rebounded quite strongly. Our own statistical work has showed in the past that when you do see energy costs really increase, as they have, and looks like they may even do again, that's very much associated several quarters later with a peak in urban core rent growth. So at the same time that the periphery, these suburbs, these exurbs, these tier 3 or 4 markets are getting more and more expensive in real terms, the urban core is still offering a lot of opportunity when it comes to not only a relative affordability trade-off, but also some of these other affordability trade-offs related to things like energy or walkability, and perhaps even the opportunity to advance one's career by being more present in the office.
Yeah. On the investment side of the real estate market, are you seeing an increase in institutional investors or smaller players who are dealing with the challenges of raising different capital in major metros? What are some of the factors that could move the needle there?
Yes, I think smaller investors are certainly facing the challenges of higher short-term interest rates, right? So if you're a smaller investment group, you're really debt dependent, and that's that floating rate, SOFR, which basically tracks the Fed funds rate when it comes down to the debt that you would put on a property acquisition. So they're facing very severe challenges there. Larger institutions that are coming in at lower loan to values with more equity, often now from foreign investors as well, are having a much easier go of it.
And finally, Brad, what are the most important trends real estate investors should be watching as we head into the second half of 2022 and beyond?
I'm really keeping my eye on the number of housing units under construction. I mentioned earlier that if we're underbuilt by 1 million housing units, and then you've got 1.68 under construction, and then you've got some questions around U.S. population growth. The very important narrative that the U.S. had been underbuilt really since about 2014 or so, or 2013, is now certainly in the back half. That's to say that we're closing this gap, and the real question is going to be how quickly we close it, and to what degree we hit an equilibrium or overshoot, and when. And I think the really important factor on that is the number of units under construction, how they're completing, the timeliness of it, and then what these population growth figures are going to be.
Right. And of course, affordability, right? At the end of the day, that's really what home time buyers, especially in the entry level and first time, are struggling with affordability.
Oh, yes. On the single family side, certainly, I would frankly gauge that there was too much affordability the last couple of years with what were really artificially low long-term interest rates that led to this, stellar home price appreciation. The market saw that, it delivered more supply as the market signal would dictate. The question is going to be is just how impactful that supply is going to be.
All right, Brad, appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.